He wants lower rates, which really is not what we need. You could argue we need higher rates to get prices back to some form of normal, that being asset prices. You look at the Genius Act that is going to be law January 1st at the latest of next year, which synthetically drives down short-term interest rates. You look at Goldman Sachs. I mean, Trump has been badgering Powell forever to lower interest rates, and you look at what Goldman Sachs said 8 weeks ago, or a little bit longer than that, and they said if the market believes that the Fed has lost independence, gold will go parabolic. But then I ask, well, what about Stephen Mirren, who was the architect of the Mar-a-Lago Accord, who was Trump's advisor, who filled the first vacated spot at the Fed? And I think the Fed has lost independence. I think what you are looking at is further incentive for nations around the world to continue to dump treasuries and dollars. Who wants to hold dollars or accept dollars for goods and services when we are moving at breakneck speed into a devaluation of the dollar and to more suppression of interest rates? More quantitative easing, as they say, $40 billion a month that they're going to start doing, the lack of quantitative tightening, never getting your balance sheet in order. If there is no separation between the Treasury and the Federal Reserve, I think confidence exponentially erodes globally and the dollar falls further. So it's not a good look, actually. And, it to me is rather obvious what he's trying to do. The moral of the story is they want interest rates lower, which is really not good for the situation we're in. And arguably that's what got us in this problem to begin with, where asset prices have become distorted and, you have misallocations of resource and capital that has manifested itself into an environment where rates if rates don't go lower, well, and easy money doesn't continue, you end up having the whole system crush under its own weight. You pull out all of the money that the Bank of Japan now is forced to retreat from in terms of all the money that they've had spread throughout the global ecosystem because of low interest rates in Japan. Again, when the market suppresses interest rates or when the banks, handful of rich bankers suppress interest rates, instead of letting the market do it, you create distortions. Japan is going to have to deal with it. We're going to have to deal with it. And after decades of yield curve control in Japan, and that now bringing their assets and the money back home to buy Japanese government bonds, creating a domestic bid to replace maybe the waning influence of the Bank of Japan. Well, the same thing is true here. They're going to have to deal with it. We're going to have to deal with it. And I think that's what Trump understands, that higher rates will blow up everything. Stocks, bonds, real estate, the insurance companies that are loaded with treasuries, the banks. We saw what happened when the 10-year went above 5%. What happened? What if it went to 10%? And in an environment where the world is selling treasuries, he wants to do this. But it's interesting because the Genius Act will create synthetic demand for the front end of the curve. That is the end of the curve that supposedly that the Federal Reserve has the ability to control, the very, very short overnight lending market. The synthetic demand for U.S. Treasuries backing the movement of money via the stablecoin passage, the Genius Act will do just this. So unless they're going to embark upon yield curve control, and we see Japan moving away from that right now because of where they got, it's not a good thing. And we should be trying to unwind all this stuff, let alone trying to add to it. So no, I think it's a bad thing. It's a scary thing. And it just speaks to a growing rallying cry from the global south to the global south of why not to hold dollars and why to find alternate settlement routes. And also to any folks who are holding dollars, you're silly to do it. Its value is akin to a melting ice cube, and this will just make it worse.
Your point there about no matter what Trump, the administration does to direct the current or new Fed president to affect the short-term interest rates, haven't we seen, and you've talked to us for 2 years or more, 3 years, you've been beating the drum about the BRICS plus influence. If the rest of the world sees the front end of the curve being artificially clamped down by these authorities, that might in fact cause an exact acceleration, as you described, of the divestiture, the rotation out of the U.S. Treasuries and into faster than ever into hard assets such as gold and silver by those holders of current Treasuries and dollars. In the face of that divestiture by international holders of the Treasuries and the dollars, is it realistic to think that the Fed could still fight that river, fight that tide, and try to maintain the long end of the curve as well?
I don't know how you do it because, the long end of the curve, you're talking the 10-year Treasury is the primary instrument by which mortgages and credit cards are written off of, and lease rates and all that. They all come off the 10-year. Well, who wants to give our money, or who wants to give us money for 10 years at rates that are so absurdly low? I mean, if rates were to normalize to a level that was commensurate for money creation and inflation, this is why they suppress the measurements of inflation. That's why they lie about the CPI. And because if it were true, if we really understood that inflation is closer to 10 or 11%, as John Williams would say, instead of the 3 that we're being told or less, no one would buy things like 10-year Treasuries to guarantee a negative real return. So in order for the 10-year Treasury to find demand, either rates have to go much higher, or, as Judy Shelton says, peg it to gold. Now, if you peg the back end of the Treasury market to gold in an effort to continue to allow the dollar to devalue by letting gold go higher and higher and higher and higher and letting the dollar go lower and lower and lower and lower, then you don't need interest rates much higher at all. You can have virtually zero interest rates on the back end of the bond market, redeemability in gold, but gold's got to go much higher. You're going to end up giving away all your gold. So could it happen? Maybe. Maybe that's part of the plan, but I don't see how you can suppress short-term rates and let long-term rates go higher. That's really where the problem is. It's less the short-term and more the long-term rates that I think they're worried about.
If we could turn our attention to the bullion markets and physical availability, it's within this backdrop of very strong countercurrents, geopolitical tensions, and a scramble globally for access by all those countries trying to make sure that they secure and lock down supply to real assets. Can you talk to us briefly about what we know this week that we maybe didn't know last week as clearly about that fundamental drama that's going on, and then turn our attention to the repercussions in the physical availability in the retail market of investable gold and silver?
Well, we talked about the deliveries that we saw in December, which right before the end of the year, which to me is telling the real story. Delivery behavior is telling the real story. And this is not speculative positioning. This is a fight over real inventory. And to me, December really jumped out. 3,706,000 ounces of gold were delivered and 64,730,000 ounces of silver. 64,730,000 ounces of silver were issued and stopped. That means delivered. And a mint box of Silver Eagles weighs 42 pounds. What does 65 million ounces weigh? And who's doing it? But this is every single month. I've been screaming this every single month since a year ago, November. That's the largest December influx in the history of the COMEX market, which goes back to 1974. And January, which is not a major scheduled delivery month, in just the first few days of the month, we've seen pretty damn well near 35 million ounces of silver delivered. 35 million in a non-delivery month within a week of trading. You add that to what we already saw delivered in December, and you're over 100 million ounces of silver that's been delivered in a little over, a month and 5 weeks. And, that's almost the amount of silver that was mined by just the silver mining companies last year. There was 800 million ounces mined, but the silver miners, according to Rick Rule, only came up or responsible for 17 or 18% of that. So what's that? That's 12, 13 million, 120, 130 million ounces. Well, that was almost completely delivered just in the last month of December and the first 2 weeks, if that, of January. The rest was byproduct mining from the zinc, copper, and lead mines. But my point is that whoever is doing this, they're doing it for a reason. Look, in terms of silver, people need to understand it's a tiny market relative to the capital that can and is flooding into it. And when that happens, the move will be fast, as we're seeing, and disorderly, perhaps as we will really see. And in short, I think it can very quickly cascade on down into the retail market. Now, it's starting to get a little bit, it's bubbling in the retail market. It isn't where I think it needs to be. It's not frothy at all. But what you see at the highest level of huge deliveries that are as unusual as a 10-leaf clover, let alone a 4-leaf, I think it will start to trickle down into the retail market where availability becomes very difficult because we're seeing it at the highest level. And at that highest level, those institutional sized bars, well, those are the ones that find their way into refineries that make coins and smaller investable bars. So yeah, it's coming, but not here yet. But it is coming, and you can see it through deliveries that are so far outside the realm of normal that the fact that guys like Jim Cramer and any of the Main Street analysts who supposedly care about the public, the lack of any journalistic integrity is appalling to me. This, to me, is a much, much more interesting story than the crap that they talk about every day. And yet there's not a word, not even a word that silver's at all-time highs, unless it's, Reuters calling it the devil's metal and stuff. So yeah, it's just appalling to me.
Just to tag on that last point that you made, throughout December, when I ever heard the nightly news mentioning a record high gold or silver prices, it came with the statement, maybe it's a good time to unload some of grandma's silverware or some of those old, your old wedding ring or something you have along. So that's what the public is hearing is all-time highs, and maybe it's a good time to dump your physical. You've talked to us for years about the little man rule, saying that the big players position themselves ahead of time. By the time the little man gets involved, it's late in the game, and all the low risk money, as Rick Rule says, all the contrarian have already positioned themselves.
Yeah, I mean, look. Some caution is always warranted as far as what you're saying about these talking heads, especially after a move like we've seen. When everyone starts talking about something being a certainty, that's when the market will remind us that it doesn't care about your conviction. That said, in the short term, sure, it can pull back. It's a thin market. And after a vertical move, you can see what's called an air pocket or a sharp air pocket. That is a function of profit taking, of margin pressure. We saw margins increase, of headline risk. Yeah, you should sell it. It's at its top, you name it. But look, a $10 or $20 correction in silver is not only possible, it's normal in a market that's moving like this. But it's the underlying conditions that got us here. Tight physical availability, massive delivery demand, in a paper market that is now being asked to settle real-world demand, not make-believe on paper, in real metal that they may not actually have. So yeah, I mean, could the metals drop? Of course. And I'd actually be surprised if we don't get some violent pullbacks along the way. But, not trying to sound like a salesman, because I'm not. But in this respect, dips are a gift, because these dips would be driven by positioning limits or positioning and leverage, raising of margins as an example, not by a sudden surplus of metal. So I don't know. I think the bigger issue is it's not, the risk isn't in silver going from 80 to 70 or gold going from 4,600 to 400. The risk is waking up in a market, and you've seen this yourself since you and I have been working together, where you can't get what you want at any reasonable premium or any reasonable price, and the price you thought you'd be able to buy it is gone. And so yeah, short-term caution, absolutely. Long-term conviction, absolutely. In my opinion, both can be true at the same time. You can be cautious short-term, but very much convicted long-term, and that's the proper way to look at it, right? And not be so bullish that you don't see some pitfalls, but be bullish enough to hang on when you get bumped, and because the bull wants to throw you off at every chance, that's for sure.
We got some questions from clients that I wanted to bounce off you. One of them is about, will Miles Franklin and other major dealers be able to continue to buy back from the public as the price continues to fly higher? Any comments from you on the ability of major dealers like Miles Franklin to provide liquidity or for either buybacks for cash or swap for clients going forward in a rising environment?
Absolutely. Yeah, I mean, we just had a client recently who has an awful lot, liquidated 90,000 ounces of silver and 3,900 gold eagles, and we paid him right away. You're talking, it was like, I don't know, $25 million or something. Sure. We can hedge it. We have large lines of credit. We have big bank accounts that we hold specifically for this kind of stuff, and we did. And that's really not the norm these days. But yes, we will always provide a two-way market because we have the ability, for now anyway, until something happens on COMEX, to hedge our exposure to purchases and to sales and to inventory. So yes, that is the idea. We would like to be able to do that. It's the local coin shop that will have a harder time doing that as prices go higher, just for just for ensuring what they have in their store and security and all this stuff that's really getting expensive. The cost of carry is getting expensive. It's getting real. But yes, we have every intention of always providing a two-way market, and we have enough in the way of connections and with refineries and our own ability to melt things down too, where that should never be a problem.
Another question that was raised by multiple clients was about why the divergence in price between U.S. 90% silver constitutional coinage, affectionately referred to as junk silver, dimes, quarters, and half dollars, 1964 and older, the remaining at lower premiums at the moment, versus higher premiums being reestablished in bullion coins like the American Silver Eagle. We saw during the COVID crunch that both ended up quite high on premiums on those. I've tried to explain to clients about some special conditions, as you call them, anomalies that are present and have been present for the past couple of quarters regarding the low price of junk silver driven by higher than expected availability and lower than expected demand. Do you want to hit on those particular special case reasons why junk silver has been more affordable than usual? Because one of the conclusions that I think might be erroneous that one of the clients recently expressed was, he said, I've been watching this and it looks like bullion is taking off, but junk isn't. So maybe we should jump over from junk into bullion so we don't miss that increase in value.
I think the reason it happened is because there are some companies that I think are smart, like we were. And I'm not patting myself on the back, but I saw what was happening with the junk. I'll tell you why it happened. And I was watching these junk premiums collapse, and I literally told both operations in Florida and in North Dakota, go into every line of credit you have, and I will provide whatever amount of money that I have as well, and buy up every single ounce you can find in pre-65 silver. I don't care. Turn over every rock, listen to everyone who's calling you, and buy it. And that's the truth. And why did it get so cheap that I could buy it at, as much as $2 under spot at one point? Why? Or even lower. Why did that happen? Because here's how it happens. So that overhang will end quickly, and you'll see premium slingshot on it and catch up. And the reason that happened in my mind is that, so you have half a dozen companies like mine who got this, right? Maybe, us and Money Metals and APMEX and JM, whatever, they figured this out. And so they went and bought everything. But what did they figure out? And how did they figure it out? Not very hard. Here's what happens. We have 3 million ounces of silver in our warehouse right here. I will sell 3 million on COMEX paper. So as one goes up, the other goes down. If I lose $10 an ounce on my 3 million ounces in physical in the warehouse, I make 3 million, or I make $10 an ounce on those 3 million ounces, $30 million on what I sold short on COMEX. Allows me to be market neutral at any given time, right? That's how the COMEX was designed, to hedge exposure and hedge risk. Okay, great. So there you got all these smaller and mid-sized coin companies who don't. I've been doing this for 36 years next month. I know all of the traders. I know all of the refiners. I know all of the major players, and I can very quickly move things around. If you're a small local dealer, you're a small company that really doesn't have the connections, you're working with one wholesaler or whatever it may be, when this stuff comes in, when you bring, and for the last year or two, the demand by the public has been not so strong. Silver goes up to 50 and everyone starts selling this stuff, right? So the coin shops are filled with junk silver and no one's buying it. And so what do? They try and send it into the refiner to get it melted down. Now here's where it gets interesting. Remember what I said about hedging? So you're a refiner, and you're not a big one, or you are a big one. Let's say you're a big one. You have $50 million that you paid for in silver that you bought from the public. You bought candlesticks and flatware. You bought jewelry. You bought junk silver. You even bought doré. You got all this stuff that is in various stages of production. You have to melt it down into shot, which are like BB. So you got to pull out the impurity and melt it down into little ball bearing size pieces of shot. And then from there, you got to melt that down into your bars and your rounds. And the whole process in various stages can take weeks, right? Well, that $50 million in inventory, you have to hedge it, right? Or you've already paid the money. And what if the price collapses by $50 an ounce down to $30? You're out of business. You just lost, millions and millions and millions of dollars. You might as well shut down operations. So they hedge their inventory that they are working to sell. But because it takes several weeks, they're not selling it. They're not rotating their cash fast enough. So what's happened to their short position? As the price moves up by $6, bang, margin call, bang, margin call, bang, margin call. And they're getting margin called to death. And so they're like, oh my God, if we don't put up this money, they're going to close us out. They're gonna liquidate our positions. We're dead. We can't take any more business. We can't take any more business until we clean out this whole supply chain thing. We got stuff in works, yeah, but it's taking too long. And so what's happening is many of the refiners stop taking new orders for the last several months until they clean up their, what they already have in production. And as a result, the big primary distributors or anyone making a market and the stuff was paying under spot for it. And I bought every single penny I could buy, literally, because I saw that very clearly. Now this will change, but it's really because the refiners are getting margin called with their exposure to big allotments of gold and silver that they are working on refining, not moving fast enough. And the margin calls, silver moving up so fast against their short position is creating a very, very big problem for them. That's why I was able to do it. And that's why the companies that bought a bunch figured it out. A little secret sauce of running a company for 36 years that you can see it. And that's just the way the market worked. I didn't set the price, but I took advantage of it. And I sold it to the public for $1 under spot. I didn't screw anybody, of course. I wanted to give that same value that we were able to get and pass it on. So that's why it happened. And it will, once this availability is gone industry-wide, premiums will go right back up. So I wouldn't sell it. I wouldn't unless I had to. I wouldn't reposition unless I had to because, by the time this fully flushes through, you'll see much, much higher premiums, if that makes sense.
Yeah, it does. And the glut of the temporary slug of 90% silver coinage making it through the refineries, you've got to hand it to Bill Holter, our mutual friend, who says once that works its way through the snake, things will be different on the other side. So that's he always puts things in a way that are very down to earth.
There's no one like Billy, man. He's one of the most straight shooters and says it like it is, and he's right.
Your outlook for gold, silver, platinum, palladium for the year ahead?
I think that I have long-term conviction. I do. And I think prices will go much, much higher. I think there will be a great volatility. But, one of the most important tells in my mind right now is the Shanghai market consistently pricing metals above Western spot and futures. And it's basically screaming that the metal's worth far more than where it's being financially priced here in the West. And I think that's a big deal. This widening spread is a signal of tightness. It's not a rounding error. It's perhaps the beginning of real price discovery for the very first time. I guess I would say it like this. The East is doing price discovery in the physical market, and the West is still doing it price discovery in the paper market. But this spread, which continues to widen both in lease rates, which were as high as 30 or 40%, you can lease metal for short periods of time to cover, whatever it is, to borrow it and sell it or sell short, or to cover the need for it or whatever. You can do that. Those premiums are usually a fraction of 1%. They've been as high as 40%. They're about 8 or 9% right now. That's massively higher than what it normally is. And it disincentivizes leasing, makes it really hard to cover a position when you got to pay 8, 9, 10, 30% to borrow the silver. But when this spread widens, when these two worlds stop agreeing, that's when the physical market begins to overrule the paper market. And that's when the dam breaks. And I would argue the move won't be polite. You're seeing some very, very interesting things happen with the banks. Now, I told you the Tom Luongo thesis, and I kind of expanded on it. And I believe that it could very well be true. And when you see the last CTFC bank participation report that just came out, it exposes what Tom's been talking about and what I've been talking about, adding to it this silver time bomb, where non-U.S. banks are net short 206 million ounces, or 33% of open interest. And these unrealized losses are biblical in scale, done again. And what the Financial Times article says, and what the bank participation report largely corroborates, is that U.S. banks are largely net long. And as their rivals are drowning in losses, then the U.S. banks are largely net long. They did the jiu-jitsu move and they flipped. Could be very interesting. I would say that all you need to see when you talk about what could be is the amount of deliveries. And they're not slowing down. The biggest December delivery in the history of the COMEX, already this January, bringing in billions of dollars worth of gold and silver, and it's only 7 days in, but this has been every single month since last November, a year ago November. I think anyone who doesn't see this for what it is missing a very big picture. So even though we're at high points, so what? What is high when the metals have never been allowed to find price discovery? Why isn't people say that about the Dow Jones at 50,000? I started this industry, it was at 2,100 in 1990. So you tell me what is high when all of these other assets have been allowed to move higher in this inflationary world that we live in, making the people who hold assets wealthy. Why did they hold down gold and silver? And okay, they did. So now where does it go when it's no longer being held down? That's the big question. I would argue much higher with volatility,